You are listening to Charting Wealth's comprehensive review and forecast for the week beginning Monday, the 19th of December, 2016. Let's check out what's going on in these markets. We had a down day on Friday, but our candles are still strong up. We actually have finished 6 up weeks. We crossed over on our PPO, our price percent oscillator, which is the big indicator that we used. We crossed over going up back on the week ending the 25th of November, and we have seen the market actually turn around. Of course, that election week that ended the 11th of November was the up week that turned everything around, and then we had the crossover the following week, that week ending the 2nd of December, is when we saw our derivative oscillator rotate over. So we've continued to see strong growth. We have the PPO continuing to move up substantially along with the derivative oscillator and along with price action as would be expected on our weekly chart. Now let's take a look at what's actually been going on the 2-day chart. It crossed over, and remember, we see the weekly chart typically, unless there's a huge bump up in the market, something crazy good happens or something crazy bad, typically we will have the 2-day chart precede the weekly chart because the wave has to be strong enough, has to be small and build to actually pull the weekly chart over. So we saw the crossover on the 2-day chart back on the 10th. That is the 2-day candle on the 10th of November. Market originally started moving up back on the 8th of November and then pulled the weekly over going up. And of course, we want to make sure that the chart is going in the same direction on both our weekly and our 2-day chart before we look at getting in after a pullback on our 4-hour or half-day chart. So what did we see? We saw the market started moving up on the 8th of November on the 2-day chart, crossed over going up on the PPO on the 10th, and we saw the market move up, pulling the weekly over around the 23rd, and then we saw the market back off a little bit on the 30th of November, the 2nd of December, and then started moving up strongly. We have seen the last 2-day candle did show some weakness. We have an open red box candle. Now the market could be digesting the gains over the prior 8 days, but we do see the week ending with an open box. Now, it's not a solid red down candle portending lots of strong down movement, and it stayed above the 2-day trend line and well above the weekly trend line. We still have an up moving PPO. We did see the derivative oscillator lose a little bit of energy. Could the market be topping out the December effect, winding down as we end the year? That is indeed possible. If we look at the 4-hour chart, we see that it crossed over back to up, moving over back on the 15th, and then further sliding sideways and then stronger down movement on the afternoon of Friday the 16th. So we're still above the 2-day trend line. We do have a backing off. We may see a turnaround and the potential of getting back in, but of course we make no down trade now because our weekly and our 2-day are still strongly up. But we have seen the derivative oscillator building in down energy. If you rode this whole wave up, of course, you should be looking as the 4-hour starts to peter out to close your position or at least drastically reduce it, move out of it so that you are ready to take your profits. Now again, if it turns back around and continues moving up, then of course you could look to get back in. Or if you've kept a bit of your position, you could continue to ride it. But that is where we are right now, still strong up movement on the weekly and the 2-day. That is where we stand. So we're going to go back to our weekly chart and we'll move a little quicker because the S&P 500 is depicted by SPY. Typically looks a lot like IYY. We can see that crossover on the 2-day candle back on the 11th of November. The weekly pulled over on the 25th of November. The week ending then, and again on the weekly chart we always quote the day the week ends, and we have strong up movement, market still well above the weekly and the market still above the 2-day chart. We can see that the Derivative oscillators continuing to gain energy as the PPO continues to move up. It's not as strong as it was back on the week ending the 9th. That is the week ending the 16th of December. Not as strong, but still strong up movement, still open green candles. If we back down to the 2-day chart, we can see that we are barely above the 2-day trend line, still well above the weekly, and we can also see that we are flattening pretty substantially on the PPO. So pay attention to that. Could be that the S&P's move is ending. We do have a pullback. We had a pullback back on the 30th of November. The 2-day candle ending then, and the 2-day candle ending on the 2nd of December. But that was just a digesting of those gains. Sometimes the market will do that, like it eats a big meal as it moves up, then it moves up again, but we shall wait and see. Sometimes when it goes up, it turns around and comes back down. We don't want to be caught in that. Now, lastly, and remember, started moving up on that 2-day chart back on the candle ending the 10th of November is when we had that crossover. Now, if we look at our 4-hour chart, we can see a little bit more intraday. Lots of strong down movement on the morning and the afternoon on Friday the 16th, crossing over our 2-day trend line on the 4-hour chart. So a pretty substantial pullback. People are always asking, hey, if I jumped in around the afternoon of the 7th, how long do I stay in? Well, we always set our good till canceled sell orders with the kind of profit that we would be happy with in case there's a great bump up as we had, to get ourselves out automatically. And then if that doesn't trigger, as we look to see the market sliding sideways and not gaining, you would particularly look to get yourself out in a big down move like we saw with the crossover on Friday morning, or even Thursday afternoon when we had the crossover on the 4-hour chart. Particularly when you have a crossover, you don't have a lot of downward momentum. It is portending what's coming. So that's where we are on the S&P 500. Again, remember, if you're marking your daily market worksheets, total market and the S&P 500 both in confirmed up moves on that weekly chart. Going back to the weekly, continuing to move along rapidly. If we look at the Qs, Q. What do we see going on? Well, we never had that crossover going up on the weekly, so we don't have a weekly chart yet to actually help us. In other words, if we don't have that weekly crossover, even though we have the 2-day crossover going up, we don't look to make a trade on the Qs because it's too uncertain. We are trend followers and we want a strong trend. We can see on the 2-day chart the crossover back on the 8th of December, and we have 4 weeks of up movement since then. The market closed above that. The market was technically down on the Qs on Friday 0.66%. But we have strong up-moving candles and the derivative oscillators continuing to gain energy. So we'll wait and see if over the course of, as the market winds down, if there's enough to pull the weekly up. But do mark on your charts the weekly still in a confirmed down move on the Qs. So that really doesn't help us in looking for any potential trends. We've had a pullback, of course, again on the market on the 4-hour chart. So we're not making any trades at this point on the Qs. Now, lastly, before we get to the news that move the market and what might move it over the course of the following week, we're going to go to gold. What is gold doing? Well, gold crossed over, going down way back on the weekly chart on the 12th of August. The 12th of August. And we saw that the market originally moved over on that 2-day chart back sometime around the 5th or so of August, and it slid sideways for a while. Then big bump downs in early to mid-November. Then we saw the market retrace a little bit and then cross over again on the 2-day chart going down. I just recorded, and I hope that you will look and listen to it, how I'm using these vertical lines now. And these vertical lines are so helpful in helping us see where our trends are, how and when the weekly and the 2-day crossed over, and they are extremely helpful. When you see a second crossover and the weekly is continued in its down move, what a great getting in point, particularly folks that are wanting to do long-term trading. Remember, the bigger the chart, the bigger their potential of making money. Now, for those of you who aren't really up on the markets and everything we do, don't forget there are inverse funds where when the market goes down in a certain area like gold, you can get into an inverse fund in gold. And even though gold goes down, you can actually make money because the inverse fund goes up. If you haven't listened to our inverse ETFs, how to make money when markets crash, you need to listen to that. That's available at the website, chartingwealth.com, and on YouTube and at our iTunes channel. So what do we see going on? Weekly chart, confirmed down move, 2-day chart and a confirmed down move on gold. And again, our 4-hour chart, which was the chart we loved so much for gold, started failing us toward the end of the year, although it did cross over again, going down on the 5th. But what it really did is huge drop on the 15th, the morning of the 15th. Huge drop then, and it's really recovered some and sliding sideways. We're having a hard time at this point finding tradable moves in gold because it's doing the same thing that it did on the 4-hour chart at the end of the year as it did last year. The good news is the 4-hour chart started working again in January, February timeframe, and it has been a great chart. Hopefully 2016 will end and 2017 will start off, and we'll see that 4-hour chart really coming back to fruition for us. So that is where we ended the week. Gold up 0.66% at the end of the week. And just to recap, IYY, which is our total market index fund on Friday, down 0.13%. Still confirmed up on the weekly chart. S&P 500 still confirmed up on the weekly chart, down a little bit on Friday, 0.78%. The Qs still confirmed down on the weekly chart, up on the 2-day, crossing over going down on the 4-hour. But mark your daily market worksheets that the Qs is still confirmed down, so we're not trading that right now. Down 0.66% on Friday. And then gold was up 0.66%. Isn't that interesting? Gold up 0.66% on Friday, but still in confirmed down moves on that weekly chart. Now let's talk some about the news that was moving the market over the course of the last week. Well, we had that Fed meeting on Wednesday, and the Feds, of course, targeted their rate, raising it 25 basis points, or basically 0.25% into the range of 0.5% to 0.75%. I mean, still crazy, historically low rates. At least they aren't still doing quantitative easing and printing money backed by nothing at some point, making it even more difficult for us to deplete extra currency in our money supply. And of course, what we want to start seeing is the velocity of money to speed up. But so far, they've not been able to beat that in themselves. Of course, it's the marketplace that has to do that. The Fed can only do just a few things. But the move was expected, and the markets needed a breather in order to factor in what actually all of that means. The Fed also told us that they're looking for probably 3 moves over the course of 2017. So that will be interesting to see. The S&P 500 ended up increasing about 0.25% over the 5 days through the end of the week, and is up 10.83% year to date. We've also seen the European stocks, again, up for the last month about 6%, and even the Nikkei up about 8% over the same period, and about 17.5% or so over the last 3 months. 10-year Treasury yield continued to climb after the Federal Open Market Committee's announcement, and it actually reached a high of 2.58% for the week. That's its highest level since all the way back in September of 2014. So we've seen the markets basically take everything in stride as we watched those Fed announcements take place. And of course, once that percolated through, we saw how our week ended. We also had other news affecting the markets with Rex Tillerson, the the ExxonMobil CEO selected as Secretary of State. That is going to be very interesting. His choice, of course, was criticized by senators on both sides of the aisle, of course, none of whom supported Trump in his presidential bid at all, and they object to business dealings with Russia. Just, again, we'll just continue to watch how all of this plays out. What's good for business is good for the markets, is good for America. And Trump does no business, and so does Mr. Tillerson. So we'll just wait and see how that plays. What about global currencies? Well, we've seen the U.S. dollar continue to strengthen over the course of the last week against all major currencies. We've seen the Mexican peso fall 10% to the dollar. We've seen the yen fall 11%. We've seen even the Chinese yuan slide. So the capital outflows have ticked up. And Japan has surpassed China as the largest holder of U.S. bonds over the course of the last week. That is indeed interesting. Chinese government's been selling foreign currency reserves. Why? In an effort to protect its yuan. So we'll continue to see how those things play out. And there was a survey over the last week by NFIB, that's Small Business Survey, and we've seen that optimism is up about 3.5 points in November. And we also see small business owners reporting that they are less optimistic, though, about capital expenditures. So optimistic for good, better markets, but not out there looking to spend a whole lot of money. So what do we see going on over the course of this next week that can affect things? Of course, the big potentially market-moving news was that last Fed meeting this past Wednesday, but we'll see on Monday the 19th Eurozone wage figures are going to be released. We're going to see Japanese trade data and unemployment figures also that same day. We're going to see on Tuesday the Bank of Japan's going to meet to decide monetary policy. Then on Wednesday, Eurozone consumer confidence figures are going to be released, and the U.S. is going to announce its estimates for Q3 GDP on Thursday the 22nd. So not a lot of big market-moving news unless something crazy happened with any of those figures. Not very likely. Please continue to follow the markets with us every day. We will be here with you. We will be going through looking at the markets as the volume probably decreases as we get to the end of the year and the big folks on Wall Street start going on Christmas vacation. But we'll continue to look at things and see just what opportunities are held. If you have not already ordered for yourself for Christmas a copy of the Stock Traders Almanac 2017, by all means do it. In fact, it is a great idea to give that as a gift to any and everybody you know that cares about the markets. I have to say, Jeff and his father, Yale Hirsch, are the heavy lifters when it comes to helping us understand patterns, things that go on in the market on a weekly, daily, monthly, yearly basis, presidential cycle. And I would urge you, when you get your copy of the Stock Traders Almanac in 2017, first thing you do, go and start reading about the presidential cycle. I use that information constantly, something you need to be aware of. One of the cycles you can count on the most. I hope I'm selling a lot of Stock Traders Almanacs for those good guys, because I tell you, it is my main go-to publication. It is the Almanac for those of us who care about what goes on in the stock market. Thank you so much for being with us. You have questions, problems, concerns, let us hear from you. Please do listen to that latest recording that we have done for you on vertical crossovers. I really want you to get a great deal out of that and would love to hear feedback from you. You have questions, problems, concerns, needs, let us hear from you. We'll try to help in all the ways that we can. If you appreciate what we do, we ask you to subscribe to our YouTube channel. That is Charting Wealth. You can find it on YouTube. Also, the biggest thing you can do for us is go to iTunes, subscribe to our podcast. We actually have two there. The big one is the daily one to subscribe to. The weekly would be great too. And give us a 5-star rating. Say something nice about us. We so appreciate it. If you don't already have our daily market worksheet, the layout that we use at freestockcharts.com, the operative word there is free, and you don't already have the daily market worksheet, the layout that we use, and our How to Read a Stock Chart video, If you don't have those, easy way to get them, go to chartingwealth.com, sign up for the newsletter. You will get with every edition of the video podcast that we do every day. Guess what you'll get with that? You'll get the links to all three of those. So you need those. You need to fill out that daily market worksheet every single day you listen to the broadcast. Why? It will put your learning how to read stock charts on hyperdrive. Because remember, if you can read a stock chart, my friends, you can make money in the stock market. Think about it. It's like having the next day's news early. Now, is it easy to do? No. Does it take work? Yes. How much work? Well, it depends on how quickly you catch on to it. But even those who catch on to it quickly, many times it's because they're in either a rising or a falling market and things just keep going in one direction where a monkey could make money. And then things change and all of a sudden you're not as sharp as you thought you were. That's why you have to practice on a daily basis. Tune in every day. We so appreciate you being with us. God bless. Hope you're looking forward to a wonderful holiday season. All the best from chartingwealth.com.